Derivatives crisis as U.S. banks prepare for bail-ins. 1. The hidden risk. Right now, U.S. banks are holding around $223 trillion worth of derivatives. So what does that actually mean? It means banks are sitting on huge piles of risky financial bets that can collapse if the underlying loans fail. These risks are bigger and more complex than they were before the 2008 crisis, and early warning signs are already appearing. Footnote: this section explains that banks hold massive, dangerous financial bets. 2. Cracks in consumer debt. Americans are struggling with everyday bills, and car loans are becoming harder to pay. Auto lenders kept giving loans to people who couldn't afford them and then bundled those loans to make them look safe. When borrowers default, the entire structure built on those loans starts to weaken, creating the same pattern that led to the 2008 meltdown. Footnote: this section shows how failing car loans connect to bigger financial risks. 3. How derivatives multiply the danger. Derivatives are made from layers of loans, bets, and speculation. If one layer breaks, it can trigger many more failures above it. So what does that actually mean? A single group of bad loans can explode into losses across the whole banking system because of how interconnected everything is. Footnote: this section explains how small failures become large failures through derivatives. 4. 2008 is repeating. Risky loans are being packaged and rated as safe again, just like before the housing crash. These loans are then used to build even more financial products. When the original borrowers stop paying, all the layers above them begin collapsing. This is the same chain reaction that destroyed major banks in 2008. Footnote: this section shows parallels between today's market and the 2008 crisis. 5. The coming bail-ins. After 2008, new laws were passed that changed how bank failures work. Instead of taxpayers bailing out banks, the Dodd-Frank Act allows banks to use your deposits to save themselves. This is called a bail-in. Your money stays on your screen, but the bank can freeze it, convert it, or use it to stay alive. Footnote: this section explains that banks are legally allowed to use customer deposits to cover losses. 6. FDIC limits and systemic failure. Most people think the FDIC will protect their deposits, but the FDIC only holds about 1.3% of the money it insures. So what does that actually mean? One major bank collapse would drain the fund instantly. If several banks fail, the system cannot protect depositors, no matter what the insurance sticker says. Footnote: this section explains why FDIC funds are too small to cover a large crisis. 7. Real examples of bail-ins. Countries like Lebanon and Cyprus have already frozen accounts and seized deposits to keep banks running. In Cyprus, people with over $100,000 lost half their savings overnight. In Lebanon, people couldn't access their money for years. These events show how quickly access to banking can disappear. Footnote: this section shows that bail-ins have already happened in other nations. 8. Why savers get hurt first. People who save responsibly end up paying for the mistakes of large financial institutions. Those who made risky bets walk away protected, while everyday depositors lose access to their own money. This pattern happens repeatedly during financial crises. Footnote: this section explains why average savers are the ones punished in bank failures. 9. What you can still do. While no one can stop the banking system from facing risk, you can still protect yourself by learning how bail-ins work and by not relying solely on bank account for security. Some people choose physical assets like gold and silver because these cannot be frozen digitally. So what does that actually mean? It means having some wealth outside the banking system may help you during a crisis. Footnote: this section suggests basic protective steps anyone can take before a crisis hits. 10. Final warning. A derivatives crisis grows quietly until it suddenly becomes visible. The signs are already here: rising defaults, massive banking exposure, and laws that allow banks to use depositor funds. The best first step is awareness. Protecting your future begins with understanding the risks before they unfold. Footnote: this section reinforces that awareness is the first form of protection.